Welcome to the deep dive. You've given us some really interesting stuff to chew on this time, all about making sense of company earnings.
Yeah, it's a big topic.
And let's be honest, trying to understand what a company is really earning can feel like, well, like trying to decipher an ancient language sometimes.
Ha, it really can. So much jargon, so many footnotes.
Right. So our goal today is to sort of crack the code, figure out what the key information is, and hopefully leave everyone with a much clearer picture of a company's, bottom line.
Exactly. And you shared Benjamin Graham's classic thoughts on things to consider about per share earnings alongside Jason Zweig's commentary, which is always, always insightful.
Mm-hmm.
And what strikes you immediately is how Graham's initial warnings, even from way back then, still ring so true today.
He starts with this seemingly simple but incredibly important duo of ideas. First off, don't obsess over single year's earnings. Okay, seems reasonable.
Standard advice, yeah.
But then he immediately pivots and says, if you are looking at those short-term numbers, you better watch out because there's some serious potential, like landmines, buried in those per-share figures.
Yeah, booby traps, he calls them.
Booby traps. It's this constant pull, isn't it, between wanting that quick snapshot and needing the longer-term view. That makes this whole thing so complex.
And that's precisely the puzzle we're going to try and unravel for you today. Our mission, if you will, is to equip you with the ability to look past the surface of those per-share earnings figures and understand just how flexible those numbers can sometimes be.
Okay, let's unpack this then. Graham doesn't waste any time, does he? He throws us right into the deep end with the 1970 ALCOA earnings report, as it appeared in the Wall Street Journal.
Straight into an example, classic Graham.
And on the surface, it looked pretty straightforward, right? Earnings per share in 1970 were $5.20, a slight dip from $5.58 in 1969.
Okay.
And the fourth quarter even showed a little improvement year over year.
Right. So someone just glancing at those numbers, maybe a casual investor might think, okay, a small dip, company seems stable, maybe momentum's picking up.
Yeah.
And given the stock price back then, maybe that even looked like a bargain based on a seemingly attractive price-to-earnings ratio, the PE.
But here's where it gets really interesting. Graham points out that the footnote, the tiny print attached to these seemingly simple figures, was actually twice as long as the numbers themselves.
Which is always a red flag, isn't it? When the explanation is longer than the result.
Totally. And tucked away in that detail were not one, not two, but a whopping 4 different per-share earnings numbers for the entire year. And 2 just for that fourth quarter alone.
Wow. Okay, so what's fascinating here is how quickly that initial simple picture just dissolves into, complexity. You start with that easy-to-grasp $5.20.
The headline number.
Exactly. And suddenly you're faced with this whole range of possibilities. And Graham asks the critical question, which of these numbers truly represents what ALCOA earned?
Which one is the real earnings?
Yeah. And when you see the spread, the high of $5.20 compared to one of the lows for the fourth quarter, which if you annualized it, came out to just $2.80, it really hits home how different the story can be.
That's a massive difference. Nearly half?
Huge, depending on which number you choose to focus on.
So one of the reasons for this big difference was dilution, wasn't it? Can you unpack that a bit?
Sure. Dilution refers to the potential reduction in earnings per share if certain other securities, like convertible bonds or stock options, were converted into common stock. In ALCOA's case, the difference between the main earnings figure, the $5.20, and the fully diluted one was relatively small. It dropped to $5.01.
So not huge there.
Not in the specific case, but Graham is quick to point out, and this is key, that in other situations, this dilution effect can be much, much larger. It can potentially shrink those per-share earnings significantly.
Gotcha. Think of it like a pizza cut into 8 slices. If the company issues more potential shares through convertibles or warrants, it's like suddenly having to cut that same pizza into 12 slices.
Exactly. Each slice or share of the earnings just gets smaller. It's a really important factor to watch out for when you're looking at EPS.
Okay, dilution, check. But then we get to what Graham clearly sees as a major area to watch out for. These special charges.
Ah, yes, the special items.
ALCOA took a significant $18.8 million hit in the fourth quarter of 1970. That worked out to 88 cents per share. And this is where Graham's critical eye really, comes into play.
Exactly. He questions whether these charges are truly extraordinary and non-recurring, as companies often like to frame them.
Right, like a one-off thing.
Yeah. He makes a very astute point.
Yeah.
Isn't it just a normal part of business for a big, diversified company like LCOA to have some parts that aren't profitable and might need to be shut down or restructured?
That makes sense. Businesses change.
So the key takeaway for you, the listener, is to be highly skeptical, really, of anything labeled special. Often it's just the cost of doing business showing up maybe in a slightly more palatable guise.
Right. It's like saying, well, we tripped and fell, but that doesn't count as part of our regular walking. But, if you're constantly tripping.
Maybe there's something wrong with your gait.
Yeah, exactly. And Graham highlights the 4 specific sources of LCA's special charges costs tied to closing down their manufactured products division and LCOA castings.
Okay.
Losses from winding down LCOA credit and an estimated cost for some curtain wall contract. And importantly, all of these related to future events, things that hadn't quite happened yet in 1970.
And this is where the ingenious accounting, as Graham rather sarcastically calls it, comes into play.
He wasn't impressed.
Not really. By recognizing these anticipated future losses right now, in 1970, LCOA kind of avoids having to allocate those losses to specific future years.
Ah, okay.
Yeah.
So they don't quite belong to 1970 because they haven't happened?
Right.
And they won't negatively impact future years because they've already been accounted for.
It's a clever trick, maybe. But as Graham rightly wonders, does it give investors a truly clear picture of the company's financial health in any given year? It smooths things out. Maybe too much.
Especially, and this is subtle, when you notice there's no mention in LCOA's footnote about any potential future tax savings.
Good point.
If these charges represent pre-tax losses, then future earnings could not only avoid these expenses, but might even get a boost from the resulting tax credits, right?
Absolutely. Graham mentions how companies with past losses have sometimes shown surprisingly strong future earnings simply because they weren't paying much in taxes for a while. It can distort the picture going forward, too.
And the timing, taking these charge-offs at the end of 1970, a year that was already expected to be weak.
Convenient timing, perhaps?
Seems like it. It essentially cleared the decks, as Graham puts it, for potentially much better-looking figures in 1971 and beyond. Put all the bad news in one easily identifiable bucket.
And hope investors focus on the brighter, less cluttered future.
Graham even shares this almost comical anecdote, doesn't he? About another unnamed company on the NYSE.
Oh, yeah, the list of special items.
It had this incredibly diverse list, closing down UK operations, selling off their baby pants business. It really underscores just how wide-ranging these so-called extraordinary items can be.
It really does. And it's quite a shift from the older practice he mentions, setting up contingency reserves during good years to cushion the bad ones.
Which accountants didn't like.
Rightly so, because it could be used to smooth earnings artificially. Now, as Graham observes, the trend seems to have swung the other way. Companies seem eager to write off as much as possible during a perceived bad year.
Get it all out of the way.
Mm-hmm.
So what's Graham's final thought on LCA's 1970 earnings then? Where does he land?
Well, he concludes that the most likely representation of their true earnings is probably that diluted figure, the $5 or 1 cent.
Okay.
But then you'd have to subtract whatever portion of those special charges could be legitimately attributed to events that actually occurred in 1970.
And the problem is?
The problem is management didn't provide that level of detail. So the real picture remains fuzzy for investors. You just don't know how much of that 88 cents really belonged in 1970.
And you can kind of sense Graham's frustration there, can't you? With the lack of clarity.
Definitely. He felt management and auditors had a responsibility to provide a more transparent judgment on these charges, not just lump them all into one year.
Okay, so special charges are a big one. But moving beyond that, Graham briefly touches on other accounting choices that can impact reported earnings.
Yeah, it's not just the big special items. He mentions things like depreciation methods, straight line versus accelerated.
How quickly you account for an asset losing value.
Exactly. Also, how companies treat research and development costs. Do they charge it all off immediately or amortize it over time?
Right.
And even inventory valuation methods like FIFO versus LIFO, first and first out versus last and first out.
These might seem like really technical details.
They are, but they can have a very real effect on the bottom line. Graham brings up the example of Trainco.
What happened there?
A simple change back to using straight-line depreciation, which is generally seen as less conservative, accounted for half of their reported increase in earnings that year.
Wow, just from an accounting choice.
Yep. It really highlights how these perfectly legitimate accounting choices can significantly influence how a company's performance is perceived. It's not necessarily wrong, but you need to be aware of it.
And it's kind of amusing. He mentions how Wall Street analysts got all worked up over this tiny 21-cent item in Dow Chemical's report.
Yeah, debating if it was regular or extraordinary.
Graham found that level of focus on such a small amount in just 1 year to be somewhat absurd. Really, is that going to change your long-term view of Dow Chemical?
Probably not, which is a stark contrast to a truly substantial special charge. He then discusses Northwest Industries, Inc.
Right, that was a big one.
Yeah, their plan to write off a massive $264 million related to selling a railroad subsidiary and a write-down on a stock purchase.
Yeah.
That was genuinely significant.
And potentially created a big tax benefit down the road.
Exactly. A large loss like that could shield future income from taxes for a period.
And Graham, ever the practical analyst, even suggests a way to think about factoring that future tax break into the stock valuation.
Yeah, he proposes adding sort of bonus figure for that temporary tax exemption, while also, importantly, reminding us to keep potential dilution in mind.
It really just underscores his point, doesn't it? Corporate accounting can be quite tricky, as he says, and figuring out what a stock is truly worth is often complicated.
Definitely not always straightforward. Now, when we turn to Jason Zweig's commentary, we get a more contemporary take on this same core issue. But the echoes of Graham are clear.
How does Zweig frame it?
Well, he starts with a rather direct statement, doesn't pull any punches. It's not a paranoid delusion. The issuers of financial statements really are out to get you.
Okay. Sets the tone.
It immediately sets the stage for a discussion about whether the earnings numbers we see actually reflect a company's true underlying profitability or if there's some manipulation going on.
And Zweig quickly points out that even GAAP, those generally accepted accounting principles that are supposed to standardize things.
The rule book, essentially.
Even they aren't perfect. He gives a great example, right? The environmental fine.
Yeah, a company paying a fine now for pollution that happened years ago. Under GAAP, it gets booked as an expense now.
Even though it doesn't really reflect this year's operations.
Exactly. These kinds of one-off or unusual events, even under GAAP, can distort the picture of a company's fundamental health and its future profit potential.
And this is where the whole concept of non-GAAP reporting really comes into the picture, especially more recently.
Right. More and more companies are presenting these alternative earnings numbers. They essentially exclude various items they decide are unusual or not representative of their core business.
So they're saying, here's our official GAAP number, but here's the number we think you should focus on.
Pretty much. Think of non-GAAP as a company's attempt to show you maybe the movie trailer carefully edited, highlights only.
Yeah, cutting out the boring or scary parts.
Rather than the full feature film of their financial performance.
And Zweig highlights just how influential these non-GAAP numbers have become. Analysts use them, investors quote them.
Even executive compensation is often tied to these adjusted figures. He quotes Lauren Taylor Wolfe describing a system that's kind of conditioned to accept these non-GAAP notions as legitimate measures.
So what's the intended purpose? Why did non-GAAP even start?
Well, in theory, the idea behind non-GAAP is actually reasonable. It's supposed to give investors a clearer view by stripping away those truly unusual or extraordinary items like that environmental fine, maybe.
Yeah, provide clarity.
But as Zweig so aptly puts it, in practice, it's often become the devil's workshop.
Uh-oh.
Because there aren't strict, clear rules about what can be excluded, when, or why. This gives companies a lot of flexibility. They can even change their non-GAAP metrics from year to year without always having to explain why.
That sounds problematic.
It can be. He even coins this great term, non-GAAP land, to describe this almost magical place where expenses can just vanish. And temporary gains suddenly look like they're going to last forever. The examples he gives are really eye-opening.
Like what?
Groupon, remember them? Excluding their online marketing expenses from a key metric.
Their marketing expenses for an online company.
Yep. Or WeWork's infamous community-adjusted EBITDA that basically ignored most of their actual operating costs.
Oh, I remember that one. That was wild.
And pharmaceutical companies regularly excluding a big chunk of their research and development spending from their non-GAAP numbers.
Which is kind of their main business, R&D.
You could argue that, and the listener is probably thinking, wait a second, how can businesses get away with this? I can't just decide which bills I want to count this month.
Right. My mortgage is definitely a recurring expense.
And Zweig's answer is quite revealing. Often, professional investors just go along with the charade.
Yeah.
The big players, the analysts, the fund managers don't push back significantly.
And then the practice just continues.
It tends to keep spreading.
He even shares survey data, right? About CFOs and analysts.
Yeah, it shows that they themselves are aware that non-GAAP numbers can be misleading. But there's also a lot of perceived pressure to keep stock prices up, pressure related to executive pay packages tied to these numbers.
So it creates this kind of unspoken agreement almost.
It can seem that way, and research actually suggests that companies that rely heavily on these non-GAAP exclusions often share certain traits.
Like what?
They tend to be younger, smaller companies, often with high institutional ownership, and companies that have seen their stock prices rise recently. Companies, that have a strong incentive to keep that positive story going.
Makes sense. Keep the momentum up.
Mm-hmm.
Zweig then focuses in on some specific types of expenses that are frequently kicked out in non-GAAP reporting.
Yeah.
He starts with restructuring charges.
Right. These are the costs that come with things like selling off parts of the business, maybe at a loss, closing factories or offices, laying off employees. Big changes.
Okay. Now, occasional restructuring might be normal, right? Businesses have to adapt.
Absolutely. But the problem arises, as Zweig points out, when these supposedly non-recurring charges start happening, well, all the time, regularly.
If it happens every year, is it really non-recurring?
That's the million-dollar question.
No.
And the data from CalcBench he cites is pretty striking. They found a significant percentage of companies in the S&P 500 took restructuring charges every single year for a whole decade.
Every year for 10 years.
Yep. And then they turned around and added those same charges back to their non-GAAP income, effectively saying, ignore these costs.
That seems hard to justify calling them non-recurring.
It really stretches the definition, doesn't it? He uses HP Inc. as a prime example.
What did they do?
Over a 10-year period, they racked up billions with a B, in charges labeled restructuring and acquisition divestiture related.
Okay.
And pretty much all of it was added back to arrive at their non-GAAP operating income. As Zweig rightly notes, calling these things non-recurring after they happen year after year is a bit like saying the lyrics to Happy Birthday aren't repetitive.
Huh. Good one. Okay, so restructuring charges. What else gets commonly excluded?
Another major area, especially huge in the tech industry, is stock-based compensation.
Paying employees with stock options or restricted stock units.
Exactly. It can be a really significant part of how tech employees especially are paid. But this expense is very often excluded when companies calculate their non-GAAP income.
Oracle Core provides a clear illustration, right?
Yep. Their non-GAAP operating income is substantially higher, like billions higher than their GAAP figure. And the main reason, they add back those billions in stock-based compensation expense.
And does Oracle pretend it won't happen again?
No. To their credit, even Oracle acknowledges in their filings that these expenses are expected to recur in the future, but they still exclude them from their preferred non-GAAP metric.
Interesting. And the contrast with Salesforce is even more dramatic.
Even more so, yeah. Their non-GAAP operating income can be many, many times higher than their GAAP income, again, largely because they add back stock-based compensation.
What's the justification there?
The argument often goes something like, these are long-term investments in our employees, attracting talent, not directly tied to the revenue generated in this specific quarter or year, so we should show you profitability without this cost.
Okay, I see the argument, but it is a cost.
It absolutely is a cost. And then you have a company like Microsoft, which takes a completely different stance.
What do they do?
Microsoft recognizes stock-based compensation as a normal recurring cost of doing business, and they do not add it back when they calculate their non-GAAP income.
So they treat it like any other expense, like salaries.
Essentially, yes. It really highlights that there's no single consistent way companies are using non-GAAP, even for the same type of expense. And it certainly makes you wonder what's truly being represented in those adjusted numbers sometimes.
It really does. And Warren Buffett has a great quote on this, doesn't he?
Oh, it's classic Buffett. Cuts right through it. If compensation isn't an expense, what is it? And if real and recurring expenses don't belong in the calculation of earnings, where in the world do they belong?
Can't argue with that logic, really. It is an expense.
It feels pretty fundamental.
So in light of all these potential non-GAAP adjustments, Zweig kind of revisits the very definition of an income statement.
Yeah, he suggests it's increasingly becoming the part of a company's financial reports where they may exaggerate its income and understate its expenses. A pretty damning view.
He does acknowledge, though, that some companies use non-GAAP responsibly,
Right.
for genuine clarification.
He does. He's careful to say it's not always misleading. Some adjustments can be helpful in understanding the underlying business trend, but he clearly feels that far too many companies are using it to paint a rosier picture than reality warrants.
A fantasy, he calls it sometimes.
Right. And the crucial takeaway for you, the investor, is that you absolutely must do the work. You have to figure out whether these non-GAAP numbers are giving you a fair and accurate view or if they're presenting a potentially misleading fantasy.
So you can't just take the non-GAAP number the company gives you.
Definitely not blindly. It requires digging deeper than just the headline figures, understanding what they excluded and why.
Okay, stepping back a bit now, let's loop back to an earlier point Graham makes. The value of looking at average earnings over longer periods.
Yes, this is such a core Graham principle, looking at averages over, say, 7 to 10 years.
Why is that so important?
Well, it helps smooth out those short-term ups and downs, the business cycles, and crucially, it also tends to account for those special charges and credits that might distort any single year.
Because over 10 years, those special items just become part of the history.
Exactly. He even goes through and calculates LCOA's average earnings over different time frames, like 10 years and 7 years, to illustrate this. He believed most special items should really be included in that long-term average because they represent part of the company's actual operating history.
Makes sense. That longer-term perspective gives you a much more stable idea of a company's true earning power.
For sure. A single year can be an outlier for any number of reasons.
Graham also stresses looking at growth, right? Not just the level of earnings.
Yes, absolutely. The growth rate is critical. He suggests a method: compare the average earnings of the last 3 years with the figures from 10 years prior.
To see the long-term trend.
Precisely. He actually does this calculation for LCOA and also for Sears Roebuck and the Dow Jones Industrial Average at the time for comparison.
And what's interesting in his analysis is the seemingly contradictory situation he finds with LCOA.
Yeah, this is fascinating. LCOA had shown excellent earnings growth in the past, based on his calculation, even better growth than Sears and the DJIA over that period.
Okay, so good growth record.
But in early 1971, its stock was trading at a significantly lower price-to-earnings ratio compared to those other benchmarks.
Huh. So great growth history, but the market wasn't paying much for those earnings.
Exactly. It suggested the market was feeling quite pessimistic about LCOA's future prospects. Despite its strong past performance, the PE ratio was low.
It's such an important reminder, isn't it? The past isn't always prologue in investing.
Absolutely critical. Graham points out that LCOA's stock price actually peaked way back in 1959, even though its profits grew substantially in the years after that peak.
Wow. So the market anticipated the good times way in advance and maybe overdid it.
It seems like it. It just goes to show how much market expectations, future outlook, can already be baked into a company's current stock price.
So why the pessimism about LCOA in 71, despite the growth? Did Graham have a theory?
He suggests a potential key reason: LCOA's return on its capital funds, basically how efficiently it used its money to generate profit.
The return on capital, ROC.
Right. That had been only average or maybe even below average when compared to other companies that commanded much higher valuations, higher PE ratios in the stock market.
Ah, so it grew, but maybe not as profitably as the real market darlings.
That seems to be his suggestion. Companies that consistently generate better than average returns on their invested capital tend to be the ones the market rewards with those higher multiples over the long run.
He even briefly touches on his two-part appraisal process here, right? Trying to value LCOA based on its past performance relative to the Dow.
He does, but he frankly admits how difficult it is to adjust that kind of past performance value when you're anticipating potential problems ahead, like the uncertainty around LCOA's earnings in 1971 that they discussed earlier.
Yeah.
And he notes the fact that LCOA's stock price actually declined further after his analysis, even though its book value, the accounting value of its assets, was still there and growing. Market sentiment was just against it.
So Graham ultimately concludes that LCA's whole history, its price and earnings journey, while pretty unusual.
It really highlights the limitations of simply relying on typical valuation methods, especially for big industrial companies maybe facing cyclical headwinds. It's a complex picture.
Definitely. So bringing it all back home, back to those initial warnings we talked about.
Yeah.
It seems crystal clear now that just taking a single year's earnings number at face value can be a really risky move.
Absolutely. We've seen how those crucial details can hide in the footnotes.
How those special charges might not be so special or non-recurring after all.
And this whole increasingly common world of non-GAAP reporting, which can be helpful, but can also be, frankly, quite misleading.
So much potential for, let's call it financial flexibility.
That's a polite way to put it.
And for you, the listener, who's aiming to gain knowledge quickly but thoroughly, really understanding these nuances, even just by digging into one historical example, like ALCOA.
It gives you a really valuable framework, doesn't it, for analyzing the financial reports of any company you look at today. It trains you to be a much more critical and informed reader of those numbers. Ask the right questions.
Don't just accept the headline number. Dig deeper.
Precisely.
And that leads us, I think, to a final thought for you to really chew on.
Yeah.
In a world where companies have so much leeway, so much discretion in how they report their earnings, especially with non-GAAP, how can we, as investors, develop our own reliable ways to figure out a company's true profitability and its genuine long-term value?
That's the challenge, isn't it? It maybe involves looking beyond just the income statement, thinking about cash flows, balance sheet strength.
And really thinking about the incentives. Why might a company choose this particular non-GAAP metric? How consistent are their accounting choices over time? Are they always trying to present the rosiest picture, or they seem more conservative?
Those are exactly the right kinds of questions to ask. We'd strongly encourage you to take these concepts, the skepticism about special items, the scrutiny of non-GAAP adjustments, the value of long-term averages, and start digging deeper into specific company reports you're interested in.
Pay attention to those footnotes. Scrutinize those reconciliation tables between GAAP and non-GAAP. See what's being added back or taken out.
It's a continuous learning process for sure, no doubt about it. But it's one that can significantly improve your understanding of the financial world and hopefully help you make more informed decisions in the long run.